All right, Paul, we're back for another chat. It's March. What are we at? Number 5 now, I guess. Too many vacations keeping us busy, I guess. So
Yeah.
we're, the first week of March, a little bit behind when we talked last time. I'm really curious to know where your portfolio is sitting because, like, this morning was pretty rough. Not going to lie. I woke up and things looked rough.
Yeah. Today was an interesting day. I don't know if you noticed, Darren, but in the morning, my portfolio was down it's only about 1%, right? It's not really down a lot. But by the afternoon, by the close, it was up 1%. And somebody sent me a message saying that apparently Trump announced the war will be very short or it's almost over. And it's amazing how things shift because this morning I got two ETFs that hold oil companies. And this morning they were up and everything else was in the red. And I was contemplating selling my oily from Evolve. I would have realized a 25% gain in 2 months and move the money into QQCL, basically move the money into the NASDAQ. And while I was thinking about it, they reversed. So oily went down and QQCL shot up. So it didn't make the trade as attractive to me anyway. So I'm like, you know what? I'll just wait for the next day that oil seems to be popular. Maybe tomorrow morning, who knows? But it's funny how it works that way, eh? Like people, just all of a sudden on a whim change their sentiment towards stocks.
Yeah, it's so true. I don't watch the news religiously. I usually skip through it on Reddit looking for sort of hot topics as far as like what might be going on. But I know in the morning when I check, and let's face it, everybody likes checking their account. Probably shouldn't. It's probably not healthy. But at the end of the day, when I see the markets going down, I think, oh, what did Trump do now? That sounds terrible. But in this case, we're talking about a world issue for sure. This isn't just it's not just a localized issue, I wouldn't say. So yeah, since the end of February, so what is it, the date today? It's like the 9th. So in 9 days, we've seen some pretty serious changes, and it's all, I would say, due to the Iran-US and then everybody supporting that conflict there. And like you say, it's very crude focused. So it's interesting that those crude positions, would go up, because I even noticed when I filled up the other day, I don't particularly pay attention to prices because they're all about the same where I live. But I noticed when I filled my truck up, only half a tank cost me more than it usually does. So obviously that's one of the reasons it impacts that. So yeah, I hope it comes to an end, but it's part of investing is you got to be able to look at that and ride it out, zoom back out and say, like, how long will this go for? Of course, even somebody at work said to me that we had helped out at work get her set up. And she said, how do you stomach like losses like that are unrealized? Because, at last week they were around $10,000. And I told her, I said, well, in the beginning of last year, it was $30,000. So, you got to ride it out, man.
Yeah. No, dude, I mean, to be honest, Darren, it's probably better for you if the prices keep going down, right? If your portfolio keeps dropping because you're buying, right? You're what they call it, a net buyer. If you're buying $1,000, $2,000, $3,000, $4,000 a month worth of stocks, would you rather be buying XEQT today at $40 a share or at $30 a share, right? Knowing that in 10 years from now, it's going to be at $60 a share or
Yeah,
whatever,
that's so
wherever it lands, you know what I mean?
absolutely. And that's actually one of the topics I wanted to talk about today with you, is for sure that's the case. So, sometimes I wake up and check my portfolio, which we shouldn't do, but there are days when I wish I had some more cash, just probably like you feel like when it comes to your distributions and stuff, because, you're not contributing. But at the same time, yeah, of course, I want a cheaper share price. However, my strategy is solely based around dollar cost averaging. So there's plenty of days like today, because today was huge. I noticed last night when I went to bed that the overnight markets were still falling. Because I can see that. I don't know if you guys know that, but especially on the Wealthsimple app, there's overnight trading with a lot of positions, and you can actually see those changes. So when I woke up, I wasn't surprised to see a big drop, but it was pretty big this morning. And that's when I
Yeah.
was like, oh, I wish I had some more capital. And if I did, I would put it in. But with that said, I do believe in the not timing the market idea. So when I just regularly put that money in when I get it, which is every 2 weeks. If you watch my other videos, it's $1,200 right now on payday for the TFSA and $350 every week into the spousal RRSP. I just did a tax video, and I'll talk about that in a minute here to remind me about that. But let's talk about what you do now when it comes to those distributions. Because do you sit on cash in your account and look to move it around?
I do. So I do sit on cash, but not for very long, right? So if I get $4,000 or $5,000 worth of dividends, March 6th was our big payday for people who, have Evolve and Global X and Harvest, all the big players in Canada. March 6th was a big payday, right? So if you pulled in, five, six, $7,000 worth of dividends, first I have to set aside a couple thousand that I'm pulling out for the month, but everything else that's left, I'll probably spend it over the course of maybe a week. Like I won't just in one day spend it all. Because Darren, with my luck, and this happened last week, on Thursday, I bought Canny from Evolve. I put in $1,000, or not put in, but I used $1,000 worth of my dividends. And I bought Canny. I think it was at $25.04 or something, right? Sure enough, on Friday, it dropped down by like 60, 70 cents, which maybe in the long scheme of things, it won't matter too much, but it hurts a little, right? When you see it just drop that. So I try to hold on to it, maybe make a buy today, make a buy tomorrow, and spread it out over a few days, but I won't pile it up like for 6 months or something.
And do you set your drip? Like I have on most of my accounts, I have drip set onto it. And even though like I guess I should speak to some of the folks that might not get that. So drip being your brokerage would allow you to then have your distributions or dividends reinvested at no cost to you. However, as we all know, many brokerages are offering free trade. So ultimately, I don't know that there is any real impact in that regard. It's just one less thing to have to worry about every time you get paid. And then I guess in your case, like in my case, I get paid. My cover calls pay the first week. It's usually around the 6th or the 8th. And then I'll have some other funds that pay quarterly paying out through the month. And then at the end, it's usually XEI and REI, and VRE, which are my REITs, and they pay towards the end of the month. So I just set them on drip. They just do their own thing. But for you, I imagine it's a little different because you're getting paid daily and weekly and monthly.
Yeah. And I don't use drip with Wealthsimple because they won't let you pick individual ETFs to drip. Like I wish they would let you decide which ones you want to turn on and which ones you want to turn off, but you have to turn them all on, right? So if I put my TFSA to drip, then every single ETF will drip. And the reason I don't want to do that is because like HHIS is already 19% of my portfolio. I don't really want to put all of my dividends back into it. I want to have the option to buy something else. So I just let the money roll in and then pick and choose, what I want to buy. And, you know, so yeah, so I don't have the drip turned on.
Yeah, that's actually something else I wanted to talk about asset allocation, because you're kind of hitting on that a little bit, more sector allocation, specifically when it came to the oil ETF that you're talking about, or single stock if you're looking at that. I know we talked before, and I know you mentioned it in some of your videos that you're looking to reduce some of your positions. Have you started thinking about that asset allocation and how that might help balance things out? Because I kind of feel like that's what you're saying right now is when you get these distributions and dividends, and I agree, HHIS, a very concentrated position, right? You have, what is it, 19 positions in there right now?
Yeah,
And
19 or
that's
20.
very concentrated in that high tech area. So they've been getting hit pretty hard, which is why you see that price drop. But if you're looking to offset that, then you would put that money somewhere else. It's kind of like asset allocation. Do you think about that?
I do. And, Darren, at the beginning or the end of 2025, I was thinking I want to be more diversified by buying like base or indexes, like buying more foundational positions, right? But the thing is that those, or buying defensive positions like your energy, your finances, your utilities. But what happened was as people started rotating out of technology, or I guess they call them risk on sectors, right? As they started rotating out of those, they started pouring all their money into utilities, oil, stuff like that. And all of my ETFs in those sectors started to get to all-time highs. And then I started thinking, why do I want to buy oil and utilities when they're at all-time highs. Because eventually it's going to rotate out of those sectors and back into, say, technology. So in my mind, it was like, wait a minute, maybe now's the opportunity to look at some of the stocks that have been beat up and pour money into those, even though they're considered, I guess, more risky or higher risk. So, for example, I actually started trimming my ENCL from Global X, which holds oil companies, when it was at all time highs, and pouring the money into PLTE, which is Palantir. And I had one guy was great. Darren, I don't know how much you love these trolls, but one guy posted a few times in my videos that I'm just a complete idiot. And why am I selling oil and buying American tech trash? Right? And I'm like, what? So I started selling PLTE when it was $28 a share. I started buying it back again at 22, right? And then at 20, 18, all the way down to I think about 16, $17, right? I started buying it back again. And within a few weeks, it was back up to almost $20 a share. Actually, Max on Blossom, for those of you who don't know, Darren and I are both, you can find both of us on Blossom, but Maxwell on Blossom, he does his weekly buzz. I don't know if you've ever read his email. He sends out a weekly buzz. And last week, Palantir, was like one of the highest performing stocks. I can't remember how much it shot up in 1 week, but so turned out my technique of selling the oil while it was hot and buying Palantir while it was oversold, it worked out for me this time anyways.
Yeah, so I guess that's one of the things I wanted to dive into a little bit more is, so for me, just so everybody gets it, and yes, of course, we met on Blossom, and I do read that comes out from Max, because sometimes there's some good information in there. Up to you to decide. But for me, in my investing strategy, obviously I said I'm dollar cost averaging, so it's just whenever I have the money. The distributions and dividends, pretty much they just kind of go back into each fund for the most part. However, the big thing for me is I use passive. That's the tool that I use to help me figure out my asset allocation as far as the funds. Now, the funds that I'm using, and if you guys are interested in checking it out, I use Ben Felix's model, which you can find if you type in asset allocation Ben Felix model portfolio. It'll pop up. It's a PDF. It's about a 6-page document, and it goes over the different funds that he holds. To simplify it, it's interesting because the all-in-ones really fall in that bucket, and XEQT represents essentially that same bucket. I am working on my own spreadsheet, actually. I've been experimenting because for me, that asset allocation is overweighting in regions rather than just in sectors. So I try to balance it out to be diversified. So US, Canada, international, and emerging markets are sort of the big ones. So for me, rotating would mean annually rebalancing, which I've done a couple of times because I've only been at this for about 3 years. And that would mean, so for instance, if the US, which is all the tech plays and all the US companies are overweighted, then I would switch out some of those and then put them into, say, international markets. I don't necessarily look at what's not performing well. It's more like bouncing around the world than it is about the actual price. With that said, there are times when I do scratch my head and go, because like right now, over the last several weeks, there's been quite a bit of red in my portfolio. So I'm looking at certain plays and thinking, should I rotate out, as you just pointed out? Like, let's say I hold VFV, which I do, and let's say XIC, which is the Canadian fund's not doing well. Should I rotate that out? My general take on that as a longer term, well, of course, I'm older, so it's not as long as some people, but it's not beneficial to constantly be doing that. But I get the impression that for someone like yourself, or that's strictly into cover calls, that is a better play. Maybe you can you expand on that and help the audience understand why that is a better play?
Well, I think, Darren, the important thing, first of all, is that I think I'm down to now, because I've been selling off ETFs, right? I'm down to about 29. I think I'm 29 ETFs. And I'm not doing this with all of them, right? Like I'm not, I guess what you would call it is swing trading. and I'm kind of sector swing trading, at least the oil sector and then tech sector. But I'm not doing it with every single ETF that I have, right? I have just a select few that I like to do it with, and just take advantage of those opportunities where one seems to be, you know, overbought or higher than it should be, and one that's, oversold. But for the most part, you just want to buy and hold. You know what I mean? You just want to pick some good, like VFD or VU or your XEQTs as a growth investor. You just want to pick those and just keep buying them. You don't have to worry about if they're up or they're down. Just keep buying and holding on to them. Um, but as a covered call ETF investor or income investor, you know, it to me, it doesn't always make sense to be buying a fund when it's at all time highs, and you're just averaging up your price, which really reduces your yield, as opposed to finding opportunities to buy funds that are down, right? And that increases your yield by buying them low. So the other thing which was nice, is that my average cost for PLTE, which holds Palantir, was over $22 a share. And by buying it while it was so low, I brought my average cost down to, I think, about 1970 or something. So now Palantir or PLTE only has to get back up to 1970 before I break even, before I'm back in the green, right? As opposed to getting back up to $22. So for me, there's a lot of advantages to what I did.
Yeah, I guess that's why I was asking the question, is for someone that's a longer term investor, and I guess you would say like a growth investor. I guess the yield part doesn't really matter at all. You're just looking to, buy on a regular basis. Obviously, if you have like your tax return, it'd be more of a lump sum, which you guys should probably think about if you're getting your tax return.
Yeah.
But like to me, the price of VFE or VU or whatever I'm buying really doesn't, at least it doesn't factor in many times. Although I guess if I saw that, like, let's say the US was like the Canadian market sounds like it's doing better than the US market. So to overweight Canada right now might not be a good move. So if I asset allocation said to buy Canada and I knew the US was lagging behind, then maybe I would divert some. So I guess it's similar. But in your guys' case, or cover calls, it sounds like to get that yield, you need to buy the lower prices all the time rather than just keep buying.
Yeah, for sure. I mean, like for example, when you and I were buying HHIS when it was over $13 a share, right? Your yield on 25 or 26 cents, I think at the time at $12 a share, it was 25%, right? So now if you're paying 13 or $14, you're getting lower than a 25% yield. Once HHIS dropped down to like $10 a share, right? But as long as it maintains that distribution, now you're getting closer to a 30% yield. So it does make a big difference. I mean, even for, say, if you're buying VFV, what's VFV at right now? Is it 160 or 100?
162, I believe, or 161 in today's dollars.
Yeah.
The other day it was a bit higher than that, but
No, I mean, if something happened in the next week or two that dropped it down to 140 or 130 and you were able to load up on it, when it gets back up to 170, right, your gain is going to be amplified by buying it at such a low price.
yeah, I guess I was thinking because, like, with asset allocation, the spreadsheet that I'm working on right now was
I
prompted
can't wait
because
to
I'm
see
getting
it.
a lot of I'm getting a lot of comments from people that I'm well, just like you, like too many funds, too much crossover, and it did get me thinking. And I have defended why I own what I own. With that said, I was curious because I use passive to help me figure out what that asset allocation should look like. And as it turns out, after I did a little digging, I am quite overweighted. Yes, I have overlap. I get that, but the overlap's not what I'm concerned about. It's where I'm have too much. So stay tuned for that one in some of my other videos. And next month we'll probably be able to talk about it. Building a spreadsheet, which I have zero experience with, is difficult. However, I am seeing the importance of it, and what the other tools I use aren't giving me. So I guess that's why I wanted to bring that up and chat about it. Is I do see what you're saying. Like if I knew that one market was doing better, like let's say emerging markets right now were suffering, yeah, I could overweight that a little bit, and then at the end of the year look at rebalancing that to fix it. So I guess maybe I need to think my change my train of thought a little bit, but I was more curious about your guys's, what you're saying about yield is important, where with me, the yield is, it's kind of irrelevant in the long term. If I was all in cover calls, then yeah, it would be. In my case, which I guess will lead to the next topic, is, total returns. So that subject has come up a lot. A lot of people like to lambaste a lot of cover call folks about that, and the defense is always the total returns. I know you mentioned you wanted to talk to me about it because you watched my last video where I talked about my emergency fund, where I'm running a bit of an experiment to see how things will go. And I mentioned in that video that I'm not getting paid. And so I know you want to chat about that.
I was just about to say while you were speaking that total return is important as well, right? Like yield for income investors is obviously important. But if you're getting, these crazy 80, 90, 100% yields, but your fund share price or NAV, whatever you want to call it, is eroding, right? Faster than you're being paid out, then then there's no point to it. And that's what I've been trying to do is go through my portfolio and weed out the funds that were underperforming other funds, or the ones that had too much NAV erosion. For you, I know so you were referring to your video on your emergency fund, and I know you kind of set up like a case study of covered calls versus, I think it was XEQT.
Yeah, VFV, XEQT, 50%, and then the other half is in USCL, HYLD, and HHIS. 25%, of the 50% for cover calls, 25% is in HHIS, and then the other two is broken up between USCL and HYLD.
Yeah. See, I would almost look at your emergency fund kind of like my margin account, and I don't know if I would put HHIS into it because, you don't want to need the money from your emergency account at the same time that HHIS just took a dive, right? And I think you were buying it when tech was pretty hot, right? You were buying HHIS when it was doing really well because all of the tech stocks were doing well. And then, as the tech market started to cool off a bit, well, so did your HHIS. So now you're in a position where if you had to sell it, it would probably not be a good time to sell it.
Oh, it's down 20%.
Right? So that's why, for example, I didn't put HHIS in my margin account because I didn't want to risk having any funds that would drop 20%. I have QQCL, I have USCL, and they're down like 2%, which is not so bad, right? And I don't have to sell them. So
yeah, so that's, go ahead.
I was just going to say, so for an emergency account, I don't know if I would have picked HHIS. Maybe HDIV with your HYLD would have been a better match, right? Because I have HDIV in my margin account, and I can't get it to drop below my average cost. Like I want to buy more of it below my average cost, and it just won't. It just hasn't happened yet. So I think unless the market drops 10, 20%, then it'll go down. But these little like 1% a day drops it's not enough.
Yeah. So, and one of the points so I agree with you. Like we've just talked about it. HHI is a very concentrated play. Tech was doing well. I bought into it early on after the fund came out, and I haven't put any more into it, at least So I get that. But what I was trying to point out,
drip, don't you?
I do. Yeah.
Yeah.
There's in that account, there's not very much going back into it. The total amount in there is very small, as I pointed out on that video. But my point more was looking at the funds themselves. So at one point there, I guess towards the end of February, XEQT was, so it's 25%, and it was showing that it was up around 28%. And that's straight growth because there wasn't, actually, I think there might have been one quarterly payout in there, but I mean, not enough to make that kind of difference. And then obviously VFV was also outpacing the 25%, where with the other funds, regardless of HHIS, with HYLD and USCL, the dividend or distributions being reinvested, I thought that they would keep up because of total returns. Now, they didn't. And that's the part that surprised me. Now, I get that we cycled into this where the markets, and I did point that out, the markets aren't doing strongly, but still, it does make me wonder. So because I don't obviously have as much experience with the cover calls as you do. If you had to pick some funds to do that, you already mentioned HDIV. The nice thing about HDIV that I do know is that it's a pretty steady performer. In fact, I would say it's one of the stronger cover calls. Been around a long time. What is that one? 25% leverage?
HTIP, I believe so.
So if you had to replace the other ones, we already know we wouldn't use HHIS in your mind. What would be some other ones that would, and how would you manage that? Is kind of what I wanted to know, so that that total returns keeps up, because we know that cover calls do lag.
Yeah. Well, I'm almost, I've almost got my emergency fund, or what I'm calling my cash wedge, up to $15,000. And
Nice.
I was thinking about, once I hit $15,000, of talking to somebody. And I was actually thinking of Candace from Mountain Finance, maybe trying to have a chat with her as to what does she think I should put the money into, as a cash wedge. Uh, Off the top of my head, I'm thinking of funds like BMAX from Brompton, HDIV, maybe HYLD, stuff that, has that, I guess, 10, maybe 10% yield, but the share price never really seems to go down, right? Just kind of gradually goes up over time, right? Maybe slides down a little bit here and there on a bad day, but over time just keeps going a little bit higher and higher. Um, so
So
those were the ones.
you need a steady Eddie type fund that's not going to erode your NAV or your
Yeah,
share price, because that's one and the same in my view. Because you need that, you want to have that money readily available at whatever you put in. So in my case, it was 11 grand. I want to see a slow, steady growth. That's why I think some people either leave it in a high interest savings account, pardon me, or sometimes I'll put it in some sort of short-term GIC. Although even in that, if you need to access that cash right now, you're never going to get your hands on it. So
yeah.
definitely for me, it was a bit of a failed experiment. But I just wanted to see. I was curious. I think that's kind of the fun part of both being a creator as well as just learning and experimenting. And you're making some good points. It's clearly you got to pick the right funds. Like obviously XEQT, if I put all my money in XEQT 2 weeks ago would have been great. Today, terrible. Like,
When
that fund took a big hit.
when did you start your emergency account with these funds?
So that was in I started putting it back together in June. We If you didn't watch that video, we had to put a furnace and a air
Yep.
conditioner heat pump in. So we used up all our emergency fund, and at the time a lot of people on Blossom and other comments that I was reading and stuff were saying, "You know what? Because I guess the markets were good then. Why
Yeah.
would you put just money sitting around doing nothing?" In fact, I think you even mentioned that to me a couple times. So you know what? I was like, let's see what happens. And now, don't fool yourselves. We do have a line of credit. That's not ideal. Like, there's no point in investing your money only to borrow your money again at a interest rate. But so I'm not concerned about that money the way it was. But at this point, it's very obvious that we got to build up the cash reserves. So in the meantime, that's why I'm not putting anything in it. But I'm curious to see. We'll just leave it as it is and see how it performs. And now, so based on all that, that was like June, July, August, September. So it's been several months. Now, the
Yeah.
last contribution was made right in December. I believe I pointed that out in the video. So we've had 2 solid months of no contributions, and just market and returns. And so that's why I was saying, like, this isn't quite working out. So maybe I chose the wrong funds, but I don't see the total return is all I was trying to point out.
Yeah. How much is your XEQT up in that account at the moment?
So they're pretty simple numbers. It was $500, and I can't remember what the percentage was. And before the end of February, that's what was carrying the growth in that account. And then as soon as HHIS started getting beat up, because HYLD and USCL, they didn't really get beat up too bad. Like you said, maybe 1% or something. It's pretty small, not something I'd be overly concerned about. I'd rather see it growing. But yeah, HHIS, it basically took away all the
Yeah.
growth on the one side. It dragged all the growth out the other. So it's down somewhere around $500 or $600. That's why it's sitting the way it is. It just keeps coming up to 11,000 and back down. That's where it is right now. And obviously, with the markets being the way they are right now, it's going to take a bit for it to recover. So
No, but your XEQT position in that portfolio, how much is
yeah,
it
up
up?
$500.
It's up 500.
Yeah, that's what I was saying.
And
So
how much did you start with?
I'd have to look at the exact amounts. My phone is
Oh,
the one I'm using to
okay.
record this with. So,
'Cause I
but to
uh,
take a guess, it you just have to do the math on the share price, but it's 25% of that whole account. So, if whatever
like
that works out to,
like
I can't
2,500,
remember.
around
Yeah,
2,500.
something like that. So, and to be fair, like, yes, it's an all equity play. So when the markets get hit, just like anything, it's going to get dragged down. Like, I'm not saying it's perfect in any way, but it was
Yeah.
surprising to me to see that when we talk about total returns, that even with HYLD and USCL in there, that it wasn't even keeping pace. So yeah, that was really my whole point to that.
Yeah. Well, yeah, I guess you'll have to wait and see what happens when the tech sector recovers and HHIS recovers, and how much it adds to your portfolio at that time. Because I know at one point my HHIS was up about 30%, and I think now I'm up about 8%, something like that.
Yeah, it's definitely like the distributions they're high. There's no doubt about it. I think it's 27 cents a share, I believe is what it's paying right now.
Yeah,
But that's why in that same video, my month end video, I talked about it would be nice if the different providers or the different companies would put out how much and I don't know, maybe I'm looking at this wrong, but when you get a dividend from a fund, you know that the company decided to pay X amount back to the shareholders is kind of how it works. Generally speaking, folks, don't beat me up in the comments now. But with covered calls, you're generating a premium, but you never know what the premium return was. So if I write the call, somebody buys the call, the company gets the premium. Some companies will report that you got 100% rock in the month because they didn't generate enough premium. In other ones, they'll show you that it was, well, in the same one, it might show you 80% or whatever, but other ones don't even report it. So you don't know actually how much. And I guess that's why you have to watch the share price and the NAV, one and the same. If they're really starting to fall, you know that you're basically getting your own money back at that point.
yeah. At the end of the year, they do have to report it for tax purposes, right?
So what does that come out as? What do they report it as? Is it a
I,
T3?
I I think you have to go on their. Well, I don't know if they actually send you a T3 or not, but I think if you go on their website, they have to have something in there where it shows how much money they paid out that year, and how much of that money was interest, how much of it was like, I guess, regular dividends, how much of it was rock, how much of it was capital growth
So
or
you got to
capital
be an
gains.
accountant to figure it out, which is kind of my point. I wish it'd make it a little easier. It uh, it would just show like an investor like, oh, we're getting 50% of the time we're getting distributions from the money that they generate through those premiums. That might encourage you to buy another fund or not. But I guess you'd have to look at, like you say, that makes sense at the year end to look and do the math yourself and figure out, oh, last year there was only 30% of the time they were actually returning the distributions through the premiums. It's an
Yeah.
interesting subject for me at more of a learning point, I guess.
It is, but and there's also another thing for you to look up and try to figure out exactly how it works. There's the good rock, and then there's the bad rock, right? On the one hand, they might be distributing what they've earned, but there's an accounting way that they can write it off as rock. And the benefit to you, if you have it in a non-registered account, is you don't have to claim that for taxes until you sell the fund, and then it
Y-
becomes capital gains as opposed to, I guess, dividend income.
Yeah, that was going to be my next question because I do know that exists. I'm doing my taxes right now. Pardon me. I'm doing my taxes right now, and I use Well Simple's tax program. It's pretty easy. In fact, if you watch the last video that I did, we're Generations clients now because I moved all our money over. And for Generations clients, you actually get a tax planning session. I did that today, actually. It was actually kind of interesting. And they'll go over some of those things with you. It's pretty short. It's only 30 minutes. But that's one of the things that kind of came into my mind. I don't have any non-registered accounts, but I was thinking, like, I wonder what that would look like, because I know that they can do that, but I don't understand enough about it right now. So maybe you guys that are watching that are a little smarter than me, leave it in the comments. Kind of point
Explain
us
it.
in the right direction when it comes to that, because I am. You're right, Paul. It's something I do want to learn more about.
I was talking to somebody on Blossom who's an accountant, and he was talking about coming on the channel, and he was trying to get approval at work to do it. And then I haven't heard from him in a while, so I'm gonna have to go back through all my private messages on Blossom and try to find him and see what's going on. This would be the perfect time of year for him to come on the channel and explain some of this stuff to us.
Yeah, and I think I mean, obviously for growth investors, there's an impact, like you said, even if you've outpaced like all your RRSPs and TFSAs and you're using non-registered. But it sounds to me like it has more of an impact on someone that's all in covered calls, as far as that goes. So it's an interesting subject. Definitely one maybe we can revisit on another video after doing a bit more research, because it's busy time right now. I'm working
Yeah.
on the taxes, shooting videos, working hard.
Honestly, Darren, I think it's probably not a bad problem for people to have. I mean, if you can max out either in Canada your RSP or in the States your 401k, you can max out your TFSA or your Roth, and you've got even more money that you can put it into a non-registered account. I wouldn't complain about, you know what I mean? If I had a few $100,000 in my non-registered account that I had to worry about the taxes, right? It's not
Yeah,
a bad problem to have.
no, not at
So
all. Yeah. Which actually brings me to another question. Imagine you're working on your taxes as well, and in the past with me, what we've done is, and we used to spend that money. We get a tax return, and it would fix the roof or whatever needed to be done. Might go to a trip or something. Now, after a little bit of education over the last few years, I realized the snowball effect that I
yeah.
hear talk about distributions and dividends. Man, that's so powerful. And I've seen that this is going to be the third year in a row that we'll be putting our money back into the accounts. In this case, it'll be our spousal, and I can see the snowball happening. And the last video that I did, I talked about the importance of the tax planning. It's, you know, they always say, like, if you listen to a lot of people out there, investing's been mastered. It's pretty simple as far as like where you put your money. But if you don't plan for the rest of it, as an example, if you're making the second tier tax bracket right now and you inadvertently put money into a registered account only to take it out later when you retire, you're paying the same taxes. So it's a bit of a game when it looks at how much am I likely going to make this year? Will I be in the next tax bracket? And if so, can I put enough away to offset that? That's how you benefit from that in the long run. Do you guys do that kind of thing?
Well, I don't contribute to my RSP anymore, but I can tell you, there's people on Blossom who explain why I think an RSP can actually be better than a TFSA, right? If you make a certain amount of money, you put a certain amount, into your RSP and you get a tax refund, and then you take that tax refund, put it in your RSP, and just, it's like a cycle, right? But in reality, people do what you just said, right? 20 years ago, I know for sure I would get a two or $3,000 tax refund, and it would be like, well, I need a new garage door, and I can't afford a new garage door, so now we're going to buy it with a tax refund. Or like you said, go on a vacation, maybe need a new fridge, whatever. That's the reality of life. People, live paycheck to paycheck sometimes. That tax refund, it helps to buy a lot of things that you might otherwise not be able to buy. So in that way, investing's not as simple as you think it is.
Yeah, I think it's more planning than it is the investing part. Like, I guess that's what I learned this year is looking back, obviously can't rewind the clock too much, but had I have done it a little differently, it wouldn't seem so painful now. But you really got to think ahead in your planning for the year. And we just talked earlier in the video about if when I see the red days and I wish I could put more money in, you really got to control yourself, because let's say you have $1,000 that's in your account and you see that day and you're like, you know what, I'm going for it. That $1,000 might be your property tax or your car insurance. You got to have a bit of a budget. You got to control yourself a little bit. So that's kind of how I'm viewing things, and that's why I wanted to do that tax video, was to show people that outside of just putting your money in a fund, you got to think ahead through the year about how you're going to stagger out your payments, where you're going to put them. For instance, you mentioned RSPs. Well, the nice thing about a tax-free savings account is it's tax-free. So the more you can have in your tax-free when it comes to retirement, the less impact it has on your income. Therefore, you're paying less taxes. So
Yeah.
and I was just listening to The Wealthy Barber. If you guys don't listen, I would suggest read his book, but also check out he's got a podcast now. I listened to it on Spotify, and man, he's got some great guests on there, and that's what they talk about, is a lot of planning. And he says investing's mastered, you got to think about it. Do you have life insurance? Do you have a current will? All of those things.
Is he on YouTube by any chance, or is it just Spotify?
I'm not sure if he's on YouTube. I believe it's just Spotify, but I could be wrong. That's where I listen to him. I don't think he's on YouTube.
Okay, I'll have to connect to my wife's Spotify account and check him out. I gave up on that. I just started using YouTube full time instead of Spotify, but maybe I'll see if I can find him on there. I'm halfway done reading his book. I'm such a procrastinator. I read half the book and then I stopped reading it. But
Is it the new one or the old one? Because he's redone.
no, it's the new one. It's really good. Yeah,
He
the new
said
one.
in today's
It's
episode, he said that it took him twice as long to write that book as it did the first one, because of all the new types of accounts and the things we're just talking about. Is back then it was basically an RRSP and maybe an RESP, but even then they didn't mean much. But now you've got the FHSA, you've got the RRSP, the spousal RRSP, the
yeah,
TFSA, and your kid's RESP, and then obviously non-registered accounts and all that. So he said he had to do a lot of research to actually write that book.
yeah, and he really modernized it, right? He kind of threw in sort of new things that weren't around when he wrote the original book, like TikTok or, YouTube or, just some references to people that are alive now as opposed to back when he wrote the book. I find it interesting. And I think, to be honest with you, I think that book is probably, if you're going to read any one book, that one could probably set you up for life. Like you said, it talks about not just investing, but insurance, life insurance, home insurance, wills, a lot of things that people ignore that are, can be very important.
The one subject that they're talking a lot right now is probate, because if you die without a will, it goes to probate, and then the government gets a bunch of your money, and you don't want that. That's why a will is important. And if you're a client of Wealthsimple, they have Willful. You can use that. I think you get a discount. I had one through work that I got a bit of a discount. My wife and I updated our will just this year because it was, it's about 13 years old now. So we just updated it to reflect every, thing that's current. And that's also equally important. Someone might have a will, but the benefactors in it, they might have passed along. The executor, they might not be around, or maybe you got divorced or something. It's really
Yeah.
important to take care of all of that. Otherwise, it's going to cost you a bunch of money in the long run.
So, Darren, have you now that you're building your spreadsheet and taking a look at your portfolio, are you going to trim some positions or?
Yeah, that's what I had said at the end of the year. Is that's the goal throughout the year, is to streamline things so that it follows along with what I intended on. As far as asset allocation, like I talked about in the beginning of the video, I want to make sure that I have enough diversification. And one of the things that's important is some people think they're diversified if they're sector diversified. So the example of that would be, I own financial, being in Canada, being the banks. I own insurance companies, and then maybe energy. So I own oil companies. I own some telecoms. I'm diversified, but you're just in Canada.
Yeah.
Diversification doesn't just involve sectors. It's important, but that's why ETFs are so good, because then you get all the companies, and then looking around the world to balance that out. And now, is there a perfect formula? Well, no, but so that's kind of what I'm gearing myself towards right now, is trimming them down to make sure that that asset allocation around the world is set properly. And I guess that's why I keep coming back to all-in-ones, because they do that for you. It's so
Yeah.
simple. You buy, they do all the balancing for you, whether it's, quarterly, or if there's big changes. Like, I imagine during a time like right now where the markets are getting hit, I imagine that the fund managers are in there probably making some changes to balance those things out, because some parts of the world might be doing better than others. So that's kind of the focus that I have moving forward. And this spreadsheet should help me with that, because I've always been looking for a tool that will kind of guide me. And I talk about it in my videos. I use Wealthica and I use Passive, but neither of them is perfect. They are suitable. They do the things I've asked them to do, but I needed something a bit more specific. So it was a fun pet project. And hopefully when I'm done, the idea would be that I'll use it, but then I'll be able to share it for viewers. It'll be a link that I'll put in the video description of future videos whenever I get it done. So yeah, that's the plan.
So, Darren, some people would argue, that just investing in the US is good enough, right? Because the American market has kind of like, led the way for decades now. Do you feel like maybe now more than ever, it's important to globally diversify?
Yeah, I guess that's why it's kind of, I was already focused on that. And that came from listening to Ben Felix and the Rational Reminder and a lot of other people. But I think the current times we're in demonstrate why that's important. World conflict is going to happen. It doesn't matter if it's Trump or someone else. That stuff happens, and it affects the markets around the world. And that's why I see that as important. Is the effects on my portfolio aren't as great as if I was all in. It's just like the HHIS point that we talked about. Very concentrated with 19 positions. They're all mostly tech, or all tech, I guess. And when they get hit, it hurts, down 20%, versus if I'm spreading it out, then it doesn't hurt quite as much. Like you mentioned, a 1% change, if on a bigger portfolio, it's a lot more money. Like percentage wise, it's really not that big. And the recovery time, like look at today, this morning, I think down about 10,000 off of yesterday, or I guess off Friday, because today was Monday. And just before we started recording, I double checked, and it's back up like 8 or 9 grand, at least as far as my portfolio does. So
That was
that's the
just
kind of
today?
swings. Yep, yep. That's the
Wow.
kind of swings. And keep in mind that with your asset allocation set up the way it is, or sectors, if, like you said, if oil gets hit hard, it's going to hurt your portfolio if there's a higher concentration in that area. Where even though I'm a little overweighted, that I've mentioned or hinted at, it's still not hurting my portfolio too terribly bad. And it's not something I'm worried about. And I think that's also key too, Paul. And I know that you and I mentioned it, you mentioned on your channel, but don't panic, man. Like if you were
No.
trying to ride it out, like let's say you were going to retire in 6 months and you didn't set up some sort of cash wedge, that's going to hurt.
Yeah.
But don't sell, man, because you're going to hurt yourself even more.
Yeah. I was actually texting, like, you and I text during the day, how's your portfolio? You're up 8, you're down 8, whatever. And my son does the same thing. He texts me, oh, dad, I'm down 2%, or I'm down $500 or whatever. And you're 21 years old. It's like, why are you even looking at your portfolio? So I kind of try to tell him, like, maybe it'd be better for you not to even open Simple unless you have money to spend, right? Like, unless he's buying. I think you and I are different because we're making videos, right? We're making content. So if we don't know what's going on in the market, then how do you make videos about it? So, and for me, I get dividends on a weekly basis, so I'm always buying or selling, but usually buying. So
Yeah, I think it's honestly, it's healthy advice too, because like I said, this person that I work with, uh, you know, uh, stomaching a loss, or at least an unrealized loss in your account, is not easy for some people. But the more you go through it, the more I guess you just get used to, that's the way it is. And I've done some videos where I've done some, you do some more research to see, like, what have the markets done over time? There was the Great Depression, there was COVID, there's all these things that happen that affect the market. But here's my analogy. I think I might have mentioned this to you before, but if I haven't, for the audience, I kind of think of it like a falling knife. It sounds silly, but today was a good example of that. When they talk about market efficiency, car, don't beat me up here. Um, so if there's a change in the market, like while you and I are talking, let's say something happens and there's an opportunity to buy. We'll just say it's energy. Let's say there's another bomb dropped. Oh my goodness, buy oil. Well, by the time you get around to doing it, the market's already sorted it out. So when people see the market crashing like that, if you just sit back, because I don't have money to buy, so I'm just watching. It seems to me you can just see in the numbers in the day, and you can see, oh, there, somebody's now caught the falling knife and they're buying up again. And so if you just sit back and wait, you're not timing the market, you're just simply time in the market. So
Yeah.
those things are always factored in. They always take care of themselves, I guess would be the most basic way to say it. If you're watching that portfolio crash like this morning, don't panic, man. It's going to sort itself out. It always has, and it likely always will. I can't say it absolutely will, but does that make kind of sense?
It does make sense, Darren. I think one thing I had somebody sending me messages and just asking questions about how I risk manage my portfolio. And he was talking about, if he owned a certain stock, like a growth stock, and it dropped down a certain amount, I guess he would sell out of it, right? And that's how he risk manages his portfolio. And I kept thinking about it. And then I watched one of Mark Beavis's videos, and it was like, if you liked a stock at $100 a share, right? Whatever stock, Petro-Canada, Suncor, Enbridge, RBC. If you like that stock at $100 a share, and because of something that happened in the news, it dropped down to 80, why do you all of a sudden want to sell out? Isn't this the time to load up? You know what I mean? Unless it was something that happened specifically to that company, right? If you heard that, they lost contracts, they're not making money anymore, whatever, then that's a different story. But if nothing's happened with the company that you know of to explain the share price decline, that's nothing but a buying opportunity, right? That's why
Absolutely.
when Palantir started going down, I got excited, right? And I watch a few YouTubers that talk about Palantir, specifically Tom Nash. And, when he says that nothing's changed, they haven't lost a contract, management team hasn't changed, I know it's oversold. And I just started buying as much as I could. Well, I should have bought more, but
Yeah, I think that's good advice. Actually, on my video that I just posted on Sunday, I had a person comment, very similarly comment, and I felt bad because, first of all, I am no financial advisor, so it's not my place to do that. You're just I do this so you get some ideas, you can follow the journey. But this person said that they had 30% of their portfolio in a single stock. Now it's a tech company, and then the rest of it was in, I believe it was in XEQT or something along those lines. And because it has been beaten up so badly, the question was basically the same thing. What would you do?
yeah,
And I felt bad. I always like to respond to everybody that comments on my videos. I am not Mr. Beast, so I don't get so many that I have to have people do it for me. But that was a tough one to answer, but I answered effectively like you just said. I said, first of all, it's not my place. I don't give financial advice, but you have to have some conviction in what you're doing and stay the course when it comes to your plan, so that when you see a position down, why'd you buy it in the first place? And then if you don't have the conviction in it and you're seeing it, tumble down, then clearly you got to cut your losses decision. And I think they're two
yeah,
different, totally different things. Um, and I guess too, I don't know this person's age or anything, so maybe it's possible they were older and maybe they need the money or something. But on a big portfolio, even like mine, like almost a $500,000 portfolio, 30%'s a lot of money in a single stock, and
yeah,
that's why you have to diversify big time, because if you put too much in one place, that's how it can hurt. But then you got to wait. You got to wait for it to recover, just like the HHIS example. I'm pretty confident that all the companies in HHIS are going to recover. Will they all go to business? No. Like you said, Paul, it's not like whatever company this person invested in, some unknown company that is going belly up that you see bankruptcy or something. That's not the case. So I
yeah,
think before you invest in something, and it's funny, I find the more videos that I do, and the more conversations that we have, there's some very, 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 very basic things that anybody can do. You just got to take a little bit of time. So, did I buy stuff when I first started? Was like, I'm just going to buy it. Of course I did. But
Yeah.
my hope is that when you watch some of our videos, you might go, well, I'm interested in this stock A or stock B. I'm going to take a few minutes to figure out which one I might have more conviction in, because that's ultimately what you want. And I think that's why ETFs get such attention, right? Is you don't have to worry too much about it. I didn't buy one company. I bought a basket of companies. So I think that's good advice for someone, is make sure you know what you're buying. And I don't mean like don't know it inside and out. That's not really what I'm saying, but have some conviction about it. Don't It's like when you go to the slot machine, right? Don't gamble. That
Yeah.
shouldn't be the way you're looking at it.
Yeah, for sure. I mean, if you're investing in a company, like Google or Amazon, Tesla, Microsoft, any of these companies, right? You're buying them, I'm assuming, with the intent of holding them for 5, 10, 15, maybe 20 years or more, right? And if that's the case, then whenever the share price drops, that's just an opportunity for you to buy. Unless, I mean, think about some of the companies like BlackBerry, right? That went from, being the top to being the bottom. But there had to be some signs, right? There had to be some quarterly earnings that they were like really failing. And at that point, you don't want to be buying more, right? Then that's when you got, like you said, that's time to sell. Time to get out as quickly as you can. But
Yeah, that actually brings up something interesting about, like, in the covered call space. I know that there's a lot of resistance, I'll say, to single stock positions for that very reason. But I think there's a subtle difference, and I'm not encouraging people here to go out and be covered call investors, but the fact is that they're different in that they generate a premium. They're generating cash flow, versus like the example you gave, like Nortel in Canada was another example.
yeah.
That's a company that needed revenues to make their business grow, and at some point, the books didn't look very good, and obviously, if you don't catch that stuff in a single stock, you could end up owning the bag. And actually, when I did my video when my dad passed away, I talked about something my parents had gone through. So any of you that watch that are older, the 2008 crisis is when my parents lost a lot of money. I had some positions that they put me in, and I have 5 digits that's sitting in an RRSP that is going to be a tax sting to me. So I got left holding the bag. So I've never really brought that up. I said I was going to do some videos on it. I want to talk about the positions that they are. I'm still trying to figure out what I may or may not be able to do with them, but effectively these companies, they're defunct for the most part, and I have 5 figures tied up in a stock that's worth nothing
Oh
effectively,
no.
and they're in an RRSP. So when it converts to RIF, I'm going to have to withdraw that money. Now, in the grand scheme of things, it's really going to be a small potatoes. And I was very fortunate. My parents, they actually replaced the money, which is in the current portfolio that we have. But that's important. And I guess I'm giving you a real world example. Like, it's not all roses. The stuff you see me talking about, yeah, it's great to see this portfolio growing, but there's a lot of pain and agony behind the scenes that, people don't realize. So I think that demonstrates that point.
Yeah. You know what, Darren? I think keep it simple, right? Is probably the best way to go. Whether you're a growth investor and you're buying VFV, or I mean, everybody loves XEQT, but I think there's a Canadian version of that as well that you can buy. We should promote Canada. um, or if you're a covered call ETF investor, you can buy HDIV, BMAX, maybe HYLD. Like there are some funds that are just really steady. And, then you don't have to make your portfolio too complicated, and you don't have to worry about if one company is doing well or not doing well, because you're actually, like you said, you're holding a basket of companies.
Yeah,
And that,
that's
that
true.
probably
Like,
should be the bulk of your portfolio, which is what I'm working on right now, is trying to get the bulk of my portfolio more into baskets as opposed to single stocks.
yeah, it certainly reduces the stress in times like this. And this is, even like you were saying, these changes, they're really not that big, like as percentage wise. So I think those are some keys. And you're right. Um, there are different funds that lean more into Canada that do into the States, or so you have to take a little bit of time to go to the website and just look at their holdings. It'll show you a breakdown around the world, especially with the all-in-ones, because they're funds of funds. And even in the cover call space, you're going to see like HYLD is a fund of funds, HDIV is a fund of funds. You have to strip the layer back, look underneath, and see what's in that fund to figure out how that fund actually works. So, and you know what? I find it interesting. If I've got some time on my hands, like I'll dive in and learn. And that's what generates a lot of the videos that I try to put out. Is it's just me learning and then sharing with you guys. Sometimes I get lots of requests for different types of videos, but sometimes I can't do them because they don't really fit into what I'm doing, and I don't have a lot of extra time. But if I do, I will try to do stuff like that. But I agree with you, Paul. I think, if I was to start again, the all-in-one space is where I'd probably lean into right away, just to get my money working and figure things out. And there's plenty of people out there that's all they invest in is just all-in-one funds.
Yeah. Are you still buying Bitcoin at all? I know you were buying Bitcoin for a while, like $100 a week or something.
Yeah, so I put $25 in every week. It's not a lot. That's a area that I I I understand the basics. I have some conviction about the idea that it's not going away, and that's important. Um, but I have this is gonna sound silly. If you guys don't watch Ryan Trahan, he's a big YouTuber. He does some videos where he tries to go like from one end of the country in the US to the other with basically no money. But he's done some videos recently where he's done it on crypto or sort of digital currency, not crypto. The one we watched last night was uh, dog something or other. I can't remember the exact type of currency, but it's interesting because some places actually take these. There's Bitcoin bank machines in convenience stores and stuff where you can actually use it. Now, he definitely demonstrated it's not as easy as it seems, and he'd have to go, like I'd have to call Paul and say, "Hey, Paul, will you take my Bitcoin and give me some cash?" kind of idea. But it's like I think I own like $300 worth of it. It's not very much, but I think the idea is that it's not going to go anywhere. So I think it's a good hedge. I kind of equate it to precious metals like gold or whatever. It's not a stock. Like it's only driven by the consumer more than anything, which is similar to a stock, but like with Tesla has a real value. When they produce stuff, it makes the company go. Bitcoin doesn't quite work like that. So the value is, and I've seen it has like some three very distinctive spikes in it, and we're
Yep.
in a really low trough right now. So I guess if you want to make that as a play as well, when it starts to go back up, you could make a little bit of money on it. But I want it as a bit of a hedge, I guess, more than anything. You don't have anything like that except your cover calls, right? Like Coney and
Yeah, I don't own any actual Bitcoin, but things like MSTE, right? Have MSTR, which holds Bitcoin. I just think it's funny, Darren, right now. Like, I'm assuming that Bitcoin will recover someday, right? But right now, while it's at its lows, nobody really talks about it. Everybody's kind of putting it down or whatever. But if it starts climbing again, all of a sudden people are going to start buying it, right? Instead of buying it now while it's cheap, once it hits 80, 90,000, 100,000, then they'll start wanting to invest again into it. But
and
I
and
think
that's just demonstrating that you have to have done the research and some conviction to know why you're doing it so that you don't get caught in that trying to catch up. That's like racing Ben Johnson, and you don't know how to run and you're just trying to catch up to him. So yeah, that's a really good point. So I didn't
it's
realize when
FOMO.
I was buying it, pardon me.
It's FOMO, right? It's fear of
It
missing out,
is.
right? Just
Yeah,
like people
that's
started, everybody wanted to buy gold once it hit $5,000 US, right? Now all of a sudden, oh, well, you should buy gold. But why didn't you buy it when it was $2,000 US,
yeah, that's absolutely
But
so true.
hindsight's 2020.
Hindsight is always 2020. All
Yeah.
right, I think we're up against time.
All right,
So
Darren.
we'll shut this one down for this month. And like I said, guys, I did do a tax video. I think it's important. And I'll do a little bit more planning. But if you want to see what that video is all about, you should watch this video right here.